Good afternoon and welcome to today's session. All lines are on listen-only mode. This call is being recorded and will be posted on the QC website. If you have any objections, please disconnect now. We will pause for questions at the end of each topic. If you have any questions, please enter them in the Q&A box located in the bottom right-hand corner of your screen. If you have joined using a browser other than Chrome or Firefox, please disconnect and join using one of those. Or if you are experiencing any technical difficulties, please use the raise hand icon and someone will assist you. With that, I will turn it over to our Director of Single Family Underwriting, Steve Glancy. Steve, the floor is yours.
Thank you. I want to welcome everyone to Freddie Mac's Let's QC quarterly webinar series. My name is Steve Glancy. I'm one of the directors in quality control. Here with me today are Julie Campbell, a credit risk policy senior, Randy Fansler, a collateral risk policy senior, Amy Johnson, a quality control manager, and Tia Hasnain, another quality control manager, and our resident compliance expert. In a few moments, you will get a chance to meet them and hear about their topics. So in this session, we will discuss with Randy and Julie Freddie Mac's ADU expansion guidelines. Amy will present scenarios on additional employed income, and then Tia will talk about the ability to repay and qualified mortgage rules. That's ATR and QM in the industry speak, as they pertain to loans delivered to Freddie Mac. As this webinar series started back in 2021 comes to a close, I wanted to remind everyone of the goals that we set out to accomplish along the way. One was to provide training and guidance. Two was to allow transparency and insight into our quality control loan review process. And three was to give you useful information to incorporate into your underwriting and QC process. So let's meet the team. So as most of you already know, I'm Steve Glancy and I'm Director of Quality Control. I just finished up my 12th year with Freddie Mac, and I've been in the industry since 2003, with almost all of that time in underwriting and quality control. I can't wait to discuss these topics. We hope the first one will be able to help our lenders expand their business and sell ADU compliant loans. And QC has been spending a vast amount of time on the last two topics. Randy, the floor is yours.
Good afternoon, everybody. My name is Randy Fansler, and I'm a Collateral Policy Manager Senior. I've been with Freddie Mac for about 7.5 years as part of the Alternative Markets QC team, and now I'm writing and updating policy for the Collateral Policy team. I'll now turn it over to Julie.
Hi, thanks, Randy. Hi, everybody. I'm Julie Campbell, and I'm a Credit Policy Manager Senior. I've been with Freddie Mac for 5.5 years. First as an underwriter on the QC team for 2 years, and then I moved to my current role in credit policy. I'll pass it along to Amy.
Amy, it looks like you might be muted.
I
So
am.
there you go. Welcome.
Thank you. All right. Hello, everybody. My name is Amy Johnson. I've been in the mortgage industry for a little over 20 years and with Freddie Mac for the last 5 years. I started my career with Freddie Mac as a QC underwriter and eventually moved into my current role as a QC manager. I'll now turn it over to Tia.
Thank you, Amy. Good afternoon. My name is Tia Hasnain. I'm a Quality Control Underwriting Senior Manager, and I have been here for 16 years and in the mortgage industry for over 27 years. Today, I have the pleasure of walking you through quality control process for qualified mortgage QM reviews from sampling to final decision, and also providing you with some helpful best practices. I will now turn it back over to Steve to get us started. Steve, over to you.
Thank you, everyone, for taking time out of your busy days to join us. Randy and Julie, back to you for ADU expansions.
Thanks, Steve. Today, I'm going to start by providing you with some recent updates to our ADU policy as part of our effort to expand eligibility for properties with ADUs. The acronym ADU, which is now a defined glossary term in our guide, stands for an accessory dwelling unit. As part of our ADU policy expansion, Freddie Mac will now allow one ADU on a 1, 2, or 3 unit property as to not exceed 4 total units. An ADU on a 2 and 3 unit property must be legally permissible by jurisdiction, meaning that the zoning compliance must be legal nonconforming, or areas with no zoning. Typical examples of ADU configurations include a unit over the garage, a unit in the basement, or a dwelling with an attached or detached unit. Our guide section 5601.2 provides all our eligibility requirements for a property with an ADU. I thought it might be helpful today to provide an overview of how Freddie Mac defines an ADU. An ADU is an additional living area that must include a kitchen, a bathroom, and a separate entrance. By having a separate entrance, it makes the ADU independent of the primary dwelling unit, which is also a requirement. The ADU must also be subordinate in living area to the primary dwelling and contribute less to the value of the property. We have a few nuances to our updated ADU policy that I'd like to point out. First, properties with 2 or more ADUs are not eligible for purchase by Freddie Mac. Second, living area with unrestricted access from the primary dwelling is not an ADU by our definition. The ADU must provide privacy from the primary dwelling. And finally, a manufactured home ADU must be classified as real property, not personal property, in order to be eligible as an ADU. Speaking of manufactured homes, Freddie Mac will purchase a mortgage secured by a 1, 2, or 3 unit property that contains a manufactured home ADU. The property must meet our guide requirements for a property with an ADU found in section 5601.2D of our guide. The manufactured home ADU must be a minimum of 400 square feet, be legally classified as real property, as I previously stated, and the primary dwelling cannot be another manufactured home unless it's a choice home. Another important update to our policy is if rental income from the ADU on a subject 1 unit primary residence is used to qualify the borrower, an appraisal report is required. Should an appraisal waiver be offered, the seller must not accept the waiver should rental income from the ADU be needed to qualify the borrower, since information is required regarding the ADU, which the appraisal report provides. This is a great segue to our next speaker, my colleague Julie Campbell, who will provide you with additional ADU updates from a credit policy perspective.
Thanks, Randy. Today I'm going to walk you through our new ADU rental income policy of our ADU expansion. We now permit the use of rental income generated from an ADU on a subject 1 unit primary residence for both purchase and no cash out refinance mortgage transactions. I'll begin with the ADU rental income documentation requirements. Documenting the ADU rental income is determined by the transaction type. For purchase transactions, a new or an existing lease may be used, or if a lease is not available, then the ADU rental analysis will be used to calculate the rental income. For a no cash out refinance transaction, there are 2 documentation options depending upon when the ADU was placed into service. When the ADU was placed into service during the current calendar year, a lease and the ADU rental analysis is required, as well as documentation supporting the date that the ADU was placed into service. When the ADU was owned in the previous calendar year, complete federal tax returns with the Schedule E are required. An exception is permitted where a lease can be used in combination with the ADU rental analysis when there's a documented event that the property was out of service for a period of time, either due to being purchased later in the year or because repairs were being completed. Now that we have our documentation, let's calculate the ADU rental income. When using a lease and the ADU rental analysis, the net rental income calculation will take 75% of the gross monthly market rent, or when using a Schedule E, the net rental income is calculated using Form 92 net rental income calculations or a similar alternative form. In addition, ADU rental income may be considered only in an amount up to 30% of the total stable monthly income that is used to qualify the borrower for the mortgage. For the example showing on the slide, when the borrower's stable monthly qualifying income is $3,000 per month, the eligible maximum ADU rental income is $900 when the 30% cap is applied. In this case, the calculated ADU net rental income of $1,100 must be reduced to $900 to qualify. Also, keep in mind that when the mortgage is a home possible mortgage, the ADU rental income must be included in the area median income determination. Now let's talk about the appraisal requirements when using an ADU rental income from the subject one-unit primary residence. In order to support the market rent for the ADU, an appraisal is required and must include a description of the ADU and the zoning designation, which must be legally permissible by the jurisdiction, which means the zoning compliance must be legal nonconforming, or in areas with no zoning. In addition, the comparable sales within the sales comparison approach section must include at least one comparable with an ADU that is rented. And the rental analysis must have a minimum of 3 comparable rentals, with at least one of those being a rented ADU. This last slide includes noteworthy points about landlord education and the IFI that is required at the time of delivery. You will note that landlord education is only required when the borrower does not have at least 12 months previous landlord experience. And lastly, I want to highlight that our existing choice renovation mortgage offering provides the option of a no cash out refinance mortgage to pay off short-term financing that was used to finance ADU renovations. This includes the addition or renovation of an ADU that is completed by the note date. Requirements for choice renovation can be found in Guide Section 4607.6. I want to thank you for the opportunity to speak about ADU rental income, and you can find those requirements in Guide Section 5306.3.
All right, we will now be taking questions. If you do have a question, please enter it into the Q&A box located in the lower right-hand corner of your screen. We have gotten a couple of questions. The first one is, can projected rental income that will be generated from an ADU on a subject one-unit primary residence be used when qualifying the borrower for a mortgage? For example, when the ADU is being added or renovated using choice renovation mortgage proceeds.
Hi, thank you. I'll take that question. The answer is it depends on when the rental income will be received. So for the rental income to be used for establishing the debt payment to income ratio when qualifying the borrower, the income must be received at the time the mortgage payments are due. If the lease does not require monthly rental income payments to begin before or on the date of the first mortgage payment due date, for example, like asked, when an ADU is undergoing construction or renovation, the projected rental income cannot be used for qualifying purposes, as the monthly income calculation would be inaccurate.
Thanks, Julie. The next question is a finished walkout basement with a bedroom, kitchen, and a bathroom considered an ADU when there is also unrestricted access, for example, an open stairway without a door from the primary dwelling unit?
Yeah, I got this one, Julie, since this is cloud related. So the answer to this question is no. The defining factor of an ADU is its independence from the primary dwelling unit. So in this scenario, the basement is not fully independent since access to the primary dwelling unit is not restricted, providing no means of privacy.
All right, I'll just give it a moment to see if we have any additional questions. We've got a couple more coming in here, just a moment. Regarding the landlord education requirement, what are acceptable forms of documentation of a history of property management?
Thanks, Kathleen. We don't prescribe which landlord education is used. There are several options available online, including the Department of HUD and various MI companies, so that you could use any of those.
Okay, another question said, I guess related to the example of home possible income inclusion. What income do you add, the 1100 or the 900?
Thanks, Kathleen. So the 30% cap applies to all mortgage types. So you would always apply the 30% limit for ADU rental income across all products.
Okay, great. Thanks so much. That's all the time we have for questions for this section at this time. If we did not get to your question, we will follow up after the session. So I'll turn the call now over to Amy Johnson.
Thank you, Kathleen. Today I'll be sharing with you two income scenarios that we generally see in quality control. The loan examples are based on actual loans that we looked at in QC. The scenarios we will be reviewing are related to additional employed income. These types of income are typically received in conjunction with the primary employment. There can be several different types of additional employed income as outlined in Freddie Mac's selling guide. But for today's presentation, the two topics we'll cover are overtime and bonus. We'll discuss documentation and calculation guidance, as well as requirements for these specific income types. So let's get familiar with Freddie Mac's Guide 5303.3, Additional Employed Income. One thing I'd like to reference is the importance of income history and stability in this section. Because additional employed income typically fluctuates, a 2-year history is required to demonstrate the stability of the income. A shorter history may be considered if the seller provides a written analysis and some supporting documentation. Other factors to consider when there's less than a 2-year history include income and employment characteristics, and the overall layering of risk factors such as the borrower's demonstrated ability to repay obligations. However, in no event may the history be less than 12 months. Next, I'd like to draw your attention to this helpful chart that provides essential guidance and requirements when using additional employed income, including 1, the history of receipt, which supports the stability and the likeliness of continuation. Also, reference to Guide section 5303.4b, which provides calculation guidance and requirements for income types. And finally, on the right-hand side of this chart lists the documentation requirements for specific income types. So now that we've gone over the guide section, let's take a look at the first scenario. Here are some facts that we know about the loan. We have an application that shows the borrower's been employed with the same employer since June of 2015 as a housekeeper. The file also contains 2019 and 2020 W-2s. Steve, taking a look at this documentation, is there anything that stands out to you as a red flag?
Yeah, those recent 2020 W-2 earnings are significantly less than the 2019.
Yeah, great catch. So keeping that in mind, let's look at the other documentation in the file. There's also a verbal verification of employment and 2 consecutive pay stubs, which reflect a consistent 80 hours or an annual base income of $62,400. We can see there's overtime and double time income listed on the pay stubs as well. So Steve, let's test your knowledge now. Do you think we have the appropriate documentation for overtime income per the guide requirements?
Yeah, I would say we do. So we've got a year-to-date pay stub documenting all the year-to-date earnings, W-2s for the most recent 2 years, and we've got the 10-day pre-closing verification of employment.
Yeah, you're correct. Now, could you calculate the qualifying overtime income with the documentation that's been provided?
Well, I think that's the tricky part. So based on the pay stubs, the year-to-date overtime income could be calculated. However, the borrower's base income is 62,400 and the 2020 W-2 only reflected 60,000. So there's insufficient income there to back out the borrower's base income and determine what amount would have been the overtime for 2020.
That's a great thought process, and I would tend to agree with you that we would not be able to determine if the borrower has a 2-year consecutive history of overtime income. Although the 2019 earnings do reflect more than the borrower's current base income, which likely includes overtime, the 2020 earnings are lower than the current base, which suggests there was no additional employed income earned during that period. So taking a look at our income calculator, you can see all of 2020 earnings are lower than the borrower's year-to-date in 2019 earnings. Because the 2020 income is less than the borrower's current base pay, this once again implies there was no additional employed income earned during the year, and therefore does not support a 2-year consecutive history of earning overtime required by the selling guide. As a result, our decision was to issue remedy since the overtime income was needed to qualify. But hold that thought, because we did receive additional documentation on appeal. So let's take a closer look. A work number verification was obtained with a breakdown of income for 2020 and 2021. Remember, the concern was that 2020 W-2 earnings did not support income above the borrower's base pay, which indicates there was no overtime. However, the breakdown of income clearly indicates the borrower's 2020 base income was much lower compared to their current base. Although we can see in 2020, we can see in 2020 the borrower actually earned $10,000 in overtime compared to the year-to-date earnings of $6,400. Steve, what do you think now? Would you say we have sufficient documentation to, one, support a 2-year history of overtime income, and two, would we be able to calculate the qualifying income based on the documentation?
Absolutely. The 2019 W-2 reflected earnings above the borrower's base income, and now the work number breaks out the 2020 and 2021 overtime income, which all supports the 2-year history.
Yeah, you're right. Again, based on the guide 5303.4B, the year-to-date income must be used when it's lower than the previous higher level. So in this case, we would use the year-to-date earnings. And as a result, we were able to accept the loan on appeal. Now let's put the viewer's knowledge to test. On the right-hand side of your screen, you'll see the poll question, which is, what is the required documentation for additional employed income for overtime? As I read the choices, please select one of the following. A, 2 consecutive year-to-date pay stubs, the most recent year's W-2, and a pre-closing VOE. B, the most recent 2 years W-2s, a year-to-date pay stub, and a VOE. C, a written verification of employment documenting all year-to-date earnings and earnings for the most recent 2 years, as well as a VOE. Or D, B, and C. We'll give just a couple more seconds for people to answer. Okay, we'll move on to the answer. And if you answered D, you're correct. Remember, the Useful Chart and Guide section 5303.d lists all the documentation requirements for each additional income type. So now that you're all experts on additional employed income, let's try another scenario. In this scenario, the documentation we have in file includes a loan application with a borrower who has been working as a Scrum Master with the same employer since 2019. The income on the application that was used to qualify shows base and commission for a total of $7,063 a month. There's also a 2019 W-2 for $79,000 and a 2020 W-2 for $73,000. And finally, we have 2 consecutive pay stubs with consistent base earnings. Steve, just like the last scenario, are there any immediate red flags that you noticed looking at the documentation?
Yeah, I noticed. So the pay stub here shows a bonus, but the application showed commission.
Exactly. Luckily, there's more documentation that was provided, so let's look and see if we can make a determination. The work number verification shows a 2-year history of commission income. But remember, one of the pay stubs, like Steve said, reflected bonus income. Now what do we do? I know, let's ask the audience. So this time, using your chat feature, let me know if 1, we can use the additional employed income based on the documentation that we have. And 2, does it matter if it's commission or bonus income? We'll allow a few seconds for people to type their answer. Okay, a lot of chats coming in. Some are conflicting answers, so we'll go to the answer. The answer is yes, we can use the income because the documentation supports a 2-year consecutive history of additional employed income. Also, it does not matter whether it's commission or bonus because the documentation and calculation requirements are the same for both income types. And in this scenario, since the most recent year is higher, we would average the 2 years according to the calculation guidance in 5303.4b. Okay, so one key takeaway I'd like to share is, although the guide does not require a complete breakdown of these additional employed income types, you can tell by the scenarios that it's helpful to obtain a breakdown, especially if the borrowers received an increase, a promotion, or even was on unpaid leave that significantly impacts the level of income. With that, thank you everyone for your participation. I hope this gave you some insight into additional employed income.
We will now be taking questions. If you do have a question, please enter it into the Q&A box located in the lower right-hand corner of your screen. All right, Amy, we have a question. Could you ask for the year-end pay stubs for 2019 and 2020 to see the breakdown?
Yes, you could, as long as the year-to-date year-end pay stubs reflect the breakdown and there's a 2-year consecutive history, you can use that.
Yeah, and Amy, I'll add that's a great alternative documentation. The work number's great, but the year-end pay stub should have the sufficient information for those years as it relates to, again, the first scenario.
Okay, going to our next question. When additional employed income, such as tip or commission income, is used to qualify the borrower, is it okay to exclude the period of unpaid time or the amount of lost revenue due to COVID-19?
So that's a great question. We're still seeing some income issues related to COVID, but the answer is no. Since the pandemic was ongoing, the pause in income is not considered a one-time occurrence. Therefore, the period of income interruption must be considered in the overall calculation. So, for example, if the borrower was a server and the restaurant was closed for 3 months, the additional employed income in this case, tip income, could not be calculated excluding those 3 months.
Okay, our next question. If you don't have a verification of income or of employment, to show how much of the income was overtime. Sorry, let me read that again. If you don't have a verification of employment to show how much of the income was overtime for the prior 2 years, then how can you determine what amount of the W-2 income was overtime?
Also, oh, go ahead, Steve.
I was going to say, if you want me to take that, I think that was sort of the point of your first scenario. You really can't determine from a W-2 how much was income or overtime. But I know in your first scenario, it appeared because the base pay they were using was less on the W-2, or the W-2 didn't match the base pay, then we could determine the initial determination is the borrower didn't even receive enough base pay and therefore didn't receive any overtime. So additional documentation would be needed. I will always say a W-2 is probably insufficient to determine overtime and additional employed income types.
Okay, we've got time for one more question for this section. Does Freddie have a preference on using pay through date versus check date for year-to-date calculations?
Amy, you're closer to loans. I'll let you go
Yep.
first, and then I'll follow up.
All right. So when calculating income, we do go by the pay period end date. That is the income that they earned through that period, and the pay date is the actual date that they received that income.
Amy will get a gold star for that one. I was going to say the same thing, that the paid through date is how much money they've earned through that date versus the date they received that check. And it can be the next day, it could be a week later sometimes. So we typically look at the pay through date.
All right, great, thank you. If we did not get to your question, you will be followed up with after this session. So with that, I will turn it over to Tia Hasnain.
Thank you, Kathleen. Thank you, Amy. Welcome all again, and thank you for staying with us. My name is Tia Hasnain. I'm a Quality Control Underwriting Senior Manager, and I've been here for 16 years and in the mortgage industry for over 27 years. Today, I have the pleasure of walking you through quality control process for qualified mortgage QM reviews from sampling to final decision and providing you with some helpful best practices. But first, a high-level overview of what the compliance group does. Freddie Mac Single Family Quality Control Compliance Group mitigates purchase risk by reviewing loans to ensure that the loans purchased are in compliance with Freddie Mac's responsible lending requirements, including ability to repay, qualified mortgage, HOPA, and state anti-predatory lending requirements, as well as the Freddie Mac Seller Servicer Guide. Today, I will specifically share with you the path a loan travels for ability to repay, qualified mortgage QM reviews, which I certainly hope results in Freddie Mac accepting the loan and retaining it. However, if a repurchase is issued, then I will discuss the repurchase and appeals process from an underwriting and remedy management perspective and the steps to final decision. Here are a few of the most frequently asked questions that I receive as a manager. Starting off, we have our loans were sampled for QM. What happens now? Next, we have what is the fastest way to get my loans through the quality control QM process? And finally, can you share tips that we can incorporate in our process that will facilitate a quicker and better outcome with Freddie Mac quality control? In order to answer the questions, it is important to walk you through all the steps that take place after your loan is sampled for QM reviews, all the way to the final decision. We start with your loans being selected for sample by our credit analytics and reporting card team, and we certainly hope the journey ends in underwriting with an accept QM decision. This is one of my favorite topics. Knowledge is key, and it is critical to making your way through the process smoothly. It is also a great opportunity for me to share valuable tools and tips that will help you as QM reviews a little unique in their sample request. It also brings me to the first and most frequently asked question as well. Why did I not receive a file request for the QM loan sample? The first unique point to remember is that there will be no loan file request letter sent out on a QM loan. A QM sample is different from regular performing, non-performing, or compliance sample, whereas a regular loan will follow the path of loan file request letter, then pre-underwriting such as imaging and indexing. All these steps are bypassed for QM samples. Quality control in collaboration with credit analytics and reporting CAR team has developed a process to test the seller's compliance with the ATR QM requirements on loans within the QC sample. CAR team utilizes data from the Uniform Closing Data Set, UCD, to determine if the points and fees or the spread is excessive by directly pulling seller-delivered data from Loan Closing Advisor. We rely on the Uniform Closing Data Set, UCD XML file data points to calculate the points and fees, APR, APOR thresholds, and check for the QM thresholds. However, there are occasions when data is either missing or CAR is unable to match the loan to a record in UCD. For instances where data is missing, the QC underwriter will request the missing data via the existing missing additional information request process that currently exists. Overall, we no longer need to request physical loan documentation and are directly pulling seller-delivered data from Loan Closing Advisor. Now, are quality control underwriters always required to issue a missing data request prior to issuing a repurchase demand? The answer is no. On this slide, I'm sharing with you the most commonly missing data requests that we send out on QM reviews using the existing additional information request AIR process in place. Additionally, these data points also impact the points and fees and spread calculations. So please review for data accuracy in UCD XML submission and Loan Closing Advisor. As a reminder, the timeline to respond to the missing data or doc request is 10 days. Now, the missing doc or data request is not an opportunity to recondition the loan, and it also cannot be used if a significant or major guide violation has been identified. Let's pause for a moment to share an example of a qualified mortgage QM Freddie Mac major deficiency that would force the underwriter to go straight to issuing a repurchase demand. If data is missing from Loan Closing Advisor, QC underwriter will issue missing data request to provide the seller with an opportunity to correct within the missing doc/data timeline. However, if the data delivered in Loan Closing Advisor results in a non-QM loan for points and fees or APR/APOR spread, the underwriter may go straight to issuing a repurchase. However, if repurchase is issued, sellers will still have an opportunity to address incorrect data via the appeals process. On this slide, I want to highlight some common themes around points and fees violation due to seller reported errors in Loan Closing Advisor. First one is incorrectly including bona fide discount points in the Reg Z total points and fee amount field, which may or may not result in an incorrect calculation. It is the seller's responsibility to accurately report the points and fees. Second one is the incorrectly reporting ability to repay ATR covered mortgages as general. For certain business purpose loans that should be reported as exempt, it is up to the seller to make that determination. There are certain loans defined in Guide Section 4202.6 where an investment property may be qualified as exempt, but not always. This is one that we frequently see. Next up, we have the incorrect reporting of Reg Z total loan amount. Then we have missing data in a required UCD data field that may cause the points and fee calculation not to be completed. And lastly, we have improper mapping of data from retail loan origination system or wholesale broker or correspondent loan feeds to their UCD XML files. In this slide, I wanted to share some reminders that the Freddie Mac QC underwriter is using lender provided data to perform the calculation for determining if the loan meets the applicable threshold for points and fees, as well as the APR-APOR spread. It is the seller's responsibility to provide accurate data, as Freddie Mac will not be using the closing disclosure to calculate the QM points and fees. An eligible or acceptable loan is one that meets all standards detailed in the Freddie Mac Seller Servicer Guide Section 4202.6. On this slide, I wanted to leave the most recent ATR QM bulletins that had been published over the past year, announcing the ATR QM requirements and how these guide bulletins continue to provide practical tips and helpful resources. The key takeaway here is that these determinations of compliance with the revised QM rule and other applicable laws are the seller's responsibility. Now, a few highlights from our Seller Servicer Guide Section 4202.6. The ATR QM requirements of the guide were updated on July 1st, 2021, and the full details can be found in Section 4202.6. One commonly asked question I often get from sellers is, where is the points and fee section specifically for ATR and QM? So for your reference, that is 4202.6C. The next most commonly asked question regarding short-term ARMs. This is the one that we get most often. So the section of the guide specific to the short-term ARMs QM APR calculation is 4202.6D Para 2, which talks about ARMs with an initial fixed period of 5 years or less. And it goes in further detail that the sellers must calculate the APR in accordance with the revised general QM rule. And we ask that you provide the required calculation to us. We're not being prescriptive in the form or format. When you receive the missing data request from us, you can even provide the APR to us on a Word document. We just need to know the APR. Now, some final takeaways that I would like to share with you. Please review and validate the loan level data. If submission is incorrect or missing, resubmit the UCD XML file to loan closing advisor to address any qualified QM related issues with the UCD submission. Repurchase notices that you receive are sent after reconciling the seller submitted data in UCD XML file provided to loan closing advisor. So always check your last resubmission and reconcile the data. For any technical questions related to loan closing advisor or UCD, please contact your client and partner delivery representative or send your inquiry to the UCD mailbox at ucd@freddiemac.com. With this, we conclude the formal part of our QM presentation, and we can now open up for any questions. Thank you.
Thanks, Tia. We will now be taking questions. So if you do have a question, please enter it into the Q&A box located in the lower right-hand corner of your screen. We've had a couple come in, Tia, so we'll get started. The first question is, can Freddie Mac's QC department resubmit loans to loan closing advisor on behalf of the seller?
Thanks, Kathleen. That is a great question. No, QC cannot resubmit. It is the seller's responsibility to resubmit the UCD XML file to loan closing advisor.
All right. The next question is, when should the ATR method be? When should the ATR method type be exempt?
So, thank you for the question. This is again a great question, and full details can be found in section 4202.6 of our seller servicer guide. But briefly, if loan is for an investment property where the borrower does not occupy either of the units, non-owner occupied, and it qualifies as an investment property per the regulation, then the ability to repay ATR method type, which is a unique UCD data point and is required in the UCD XML file, should be submitted as exempt, not as general. However, a reminder that we leave it up to the seller to make that determination, and it's specifically called out in the guide section as well. Now, another reminder in a commonly asked question we also get is, even though when you classify it as an exempt, it is called out in 4202.6 that loans that are exempt from ATR under QM are still subject to a points and fee cap. So I would like you to double check that even when you are classifying them as exempt. They're subject to a 5% points and fee cap then. So I hope that answers that question fully.
Thank you, Tia. That's all the time we have for questions for this section. If we did not get to your question, you can expect to receive follow-up on that. So with that, thank you, Tia, and I will turn the call over to Randy and Julie.
So yeah, so as a reminder, we just wanted to let you guys know that for additional information, we encourage you to take advantage of the training and resources available from the Freddie Mac Learning Center. Also, the customer call center provides seller servicer support Monday through Friday at 1-800 and the word Freddie.
And please visit the Freddie Mac single family website at sffreddiemac.com and stay current with resources there, including the single family seller servicer guide at guide.freddiemac.com. You may also find additional guidance and information, including the recordings of our Let's QC webinars, on the single family quality control page hyperlinked above.
Well, that ends our portion of the presentation for today. We hope you enjoy this webinar and that you found it useful. Steve, do you have any final words?
Yes, I just wanted to thank all our clients who joined us today and let you know that we do appreciate your business. As a reminder, if we did not get to your questions, we will get back to you directly next week. Thank you all and enjoy the rest of your day.
Thank you to our speakers, and thank you for joining today's session. As a reminder, the recording and supporting resources will be made available on the QC webpage early next week. Enjoy the rest of your day.